So welcome to this new year first incarnation of the We Are seminar series. And I'm very, very happy today to have Sarah Mouabbi with us. And she's going to discuss some very exotic financial instruments and other related things.
So indeed, today I'll be talking about joint work with Jean-Paul Helene and Jean-Guillaume Sayuk, as the usual disclaimer applies. And so we'll be talking a little bit more about what is called GDP-linked bonds or GDP-linked securities. Now, these have been dubbed as the next new thing in finance by the New York Times. There have been recurrent mentions about the use of GDP-linked bonds by numerous economists and think tanks, including the IMF, and they've been calling for the introduction of such assets. So let us try and understand what are these assets and why they advocate for such assets. So GDP-linked bonds would be assets that are state contingent, meaning their price and their payoffs depend on the state of the economy. And so if the government were to issue GDP-linked bonds, it would mean that it would service its debt more in good times, and it would service its debt less in bad times. And so many have argued that this could offer the government an automatic stabilizer to its finance. Why is that so? Well, essentially, if the debt service is linked to GDP, then the debt to GDP ratio's volatility would decrease, given that the numerator and the denominator of the debt to GDP ratio are co-moving. And that could potentially even decrease the probability of sovereign defaults. Now, in the way we're going to view it in this paper, and in fact, in the way it's been advocated by these economists, including Blanchard and Schiller, is that we are going to be looking at symmetrical risks, meaning that GDP-linked bonds payoffs increase in good times and decrease in bad times. This symmetry, the fact that you can receive lower payoffs as a buyer of a GDP-linked bonds in bad times, is going to be key for the automatic stabilization of the government. So what we're going to be doing is that we're going to be studying GDP-linked bonds under the symmetrical risk exposure. And I want to mention that they're very much the exception. So no advanced economy has issued such bonds at a large scale. There are some GDP-linked warrants that are attached to GDP outcomes, but not necessarily displaying the symmetric risk. So those assets are still hypothetical. And this is important for this presentation, to know that such assets do not exist as we speak. So let me give you the actual rationale that economists are using in defending or in being proponents for such assets. If I give the debt accumulation process as follows for a one period bond, assuming that governments can take debt of one period, then debt today would be debt issued yesterday compounded for the rate of interest minus the budget surplus, which is the net revenue of the government. Okay, so this means that the debt that you would need to raise today would be the shortfall between what you owe today from past debt and the net revenue of the government. Now you can rewrite this in the form of a debt to GDP ratio, meaning as a proportion to GDP. And this is what I have in the equation that is circled. You have the debt to GDP ratio, little dt, which essentially is going to be exactly what we had earlier on, only that the rate will be adjusted for nominal GDP, so for inflation and for real GDP. Now, in today's presentation, we're going to assume that we have three types of bonds. two that are conventional and that are issued by advanced economies as we speak, so nominal bonds and inflation-linked bonds. But we will introduce a third type of bond that the government can issue, and this is the GDP-linked bond I described earlier. So each of these bonds will have a rate, rate T. So the nominal bond has a rate, a nominal interest rate I. The inflation-linked bond will have the real rate plus compensation for inflation, and the GDP-linked bond will have its real rate, its compensation for inflation, and its compensation for real GDP. And together, these two would essentially imply that that payoffs are adjusted for nominal GDP. Now, if you introduce these rates in this circled equation, you would see that under the case of GDP-linked bonds, these terms would drop out, and it would mean that you can find a constant debt to GDP ratio for a given level of the budget surplus. So there is a level for the budget surplus such that dt is equal to dt minus 1. And so this is exactly the rationale that is used by Blanchard and by many economists when they say that the government would have an automatic stabilizer to its finance if GDP-linked bonds were issued. Now, the existing papers and analyses have several limitations. The first limitation is that interest rates are assumed to be constant. If you notice, all my nominal, my real, and my R star, which is the real rate of the GDP-linked bond, all do not have a time subscript. They're constant. They're also assuming only short-term debt being issued, only one period bonds, and they have unclear pricing assumptions. So what our paper is going to do is it's going to try and relax these assumptions. And the reason why we would like to relax them and the reason why we think they're of importance is because we know that governments usually issue long-term bonds as well, medium to long-term bonds, not only short-term bonds. So it's a simplification to only assume one period debt. But above all, we're going to start understanding what are the repercussions of assuming a constant interest rate. And to do that, I want to show you a bit of a motivational graph. I want to show you the realized over expected GDP, which is in black. And in the dotted line, I want to show you the return, the one-year return of the S&P 500. And if you notice, these two series are very correlated, and they're extremely procyclical, and they exhibit this consistent dip during recessions. Now, if I am to reproduce the realized over expected payoffs, but in the case of conventional bonds, which are in gray, and in the gray solid line, you'll have the real rates realized over expected payoff. Why is it a constant line? Because the realized over expected of the real payoff is constant by construction. It's by definition. While in the case of nominal bonds, it can fluctuate, but it will not exhibit a particular procyclical or counter-cyclical behavior. You can have a recession and have a dip, as you can have a recession and have peaks. So it's for this very reason that we believe that because GDP-linked bonds will be paying low payoffs in that state of the world, it is very likely that they will be behaving a lot like equity. In fact, they've been advocated to be one way for the government to complete its market and to offer it its equity option on top of its debt option. And so we can understand from this motivational figure that it is very likely that such state contingent asset would most likely bear large positive risk premia. And it's for this very reason that what we would like to do in this paper is we would like to allow for time-varying interest rates, because if you have a state contingent asset, interest rates will most likely be volatile, and they will be embedding risk premium. And we want to study it within a standard macrofinance model, where we want to study the specific question, which is what are the debt stabilizing properties of GDP-linked bonds? So what we're going to do is we're going to have a macrofinance model. It's going to be an extension of the Vector 2006 paper, where the key ingredient is going to be consumption habits, and where we're going to be including macroeconomic variables such as GDP, consumption, inflation trajectories, and we'll also have yield trajectories, and we will allow for the full term structure of nominal, inflation-linked, and GDP-linked bonds. What we're going to do is our model will allow for closed form approximated solutions for all assets in our model, which is actually a novelty in this class of models. We're the first paper that is able to do that. And we will calibrate this model based on moment fitting, and our empirical analysis will be based on the US throughout the period spanning from 1985 to 2018. So once we have this macrofinance model, what we're going to do is we're going to impose some issuance strategies. Excuse me, let me first mention the second building block. I'm sorry for skipping this step. So once we have our macrofinance model, now we want to see what happens to the debt accumulation process. So what is going to happen is that we're going to take this debt accumulation process, but we will generalize it for the existence of any type of bond, for the issuance of any type of bond, for any maturity, okay? And once we've generalized this debt accumulation process, what we can do is we can impose issuance strategies. We can embed the trajectories of our macrofinancial variables within the debt accumulation process, and we can extract implications on the debt schedule, on the debt of a government, and on its issuance. So this is going to be the plan and the strategy that we will follow. Just to give you a bit of a heads up on what are the main findings we're going to have. So first of all, we will find that indeed there is countercyclical interest rates for GDP-linked bonds, and that they will embed a positive risk premium of about 40 basis points on average across the maturity spectrum. The GDP-linked bond risk premium is defined in our setting as the average excess return over the inflation-linked bond of the same maturity, okay? We could have defined it as the average excess return over the nominal bond, and we could have produced everything in nominal terms, but it's a choice, and we can do either of the two. But just for your information, within throughout our presentation today, the main key comparison will be to compare GDP-linked bonds to inflation-linked bonds, essentially. Now, GDP-linked bonds will also make it easier. So although they embed a positive risk premium, they will make it easier to forecast the debt to GDP ratio in the short to medium term, okay? However, and this is when we start contrasting our results from what the literature finds, we find unclear abilities of GDP-linked bonds to avoid high debt to GDP ratios in the long run. And finally, the debt stabilizing budget surplus will be more predictable but higher on average. So in a nutshell, such bonds at least seem to really act as a hedging instrument, meaning that they're going to be more expensive, but they will allow to reduce volatility to an extent.
So just a clarifying question, Sarah, then. So yeah, I was wondering about the maturity structure, because it's very complicated to take all of that into account. You have different types of bonds, and then you are allowing for long-term and short-term debt. So in the model, the issuance is going to be, you're going to take the maturity structure as given in terms of issuance, or you cannot optimize on it, right? It's too complicated.
We are not going to optimize on the issuance, on the maturity. So it's not an optimal maturity kind of paper, and there is going to be no welfare analysis either. And I will tell you why that is the case. But what we're going to do is that we are going to say, for a given maturity structure, we're going to do a horse race against the three types of bonds that exist in the economy to see which one will provide better debt service outcomes for a government. So it's really, we're taking a perspective of debt stabilization, and this is what we're going to be looking at in particular. Absolutely.
Thank you.
Thank you very much for the question. This brings me to the model. I will not, I will skim through it, but if you have any particular questions, I'm happy to go through it. But I just want to mention the reason why there is no welfare analysis. So consumption in our case will be an exogenous process. So it will not be able to respond to the different debt the government is issuing. Okay. And therefore, it will be the same process no matter what debt the government issues. And the disturbance of this process nu T will enter the dynamics of real GDP and of inflation and of dividends. So as I mentioned, equity and GDP-linked bonds will share a lot of similarities based on this graph here. And given that GDP-linked bonds are hypothetical and that we do not have prices for GDP-linked bonds, our macrofinance model will be pricing them with the help of macro variables of existing bonds, conventional bonds, but we will also include equity so that we can so that we can benefit from these large correlations we see on this hypothetical asset. So our model will also include the log of real dividends, and we will follow a very standard asset pricing model where the main ingredient is going to be habits. These are external habits. And so essentially, the key variable in our model is going to be the surplus consumption ST, which tells you how far aggregate consumption is from this external habit level XT. So if you have a wide gap between your aggregate consumption and habit, you will be less happy in a way, and you'll be pricing risk more, and vice versa. When you are going to be close and you'll be closing the gap, you will be happier. And so we with this model, so both macro variables, financial variables, and preferences of agents, of a representative agent that follow the following pricing kernel, what we are able to do is we're able to derive approximate analytical solutions for all of our assets, the three types of bonds, and for equity. Okay, this means that we will be able to have nominal and real interest rates have this form, which is solved analytically, and the same thing for GDP-linked bond interest rates and for stocks. So given the limit of time, what I would like to do is I'd like to move to showing you some results. I will just briefly tell you how we calibrate the model. But again, if you have any questions on the model, please feel free to tell me. Now, some parameters are going to be calibrated. These are typically preference parameters, and they're going to follow very closely the literature. Some parameters are going to be estimated to fit moments, and we're going to be looking at a very wide array of moments. So GDP growth, consumption growth, inflation, nominal and real interest rates. We're going to proxy for interest rate conditional variances as well, and we're going to include equity price and dividend data. So let me jump to some first results. So first, as I mentioned earlier, I am defining the process. I'm defining the asset of GDP-linked bonds as being identical to inflation-linked bonds in the absence of GDP uncertainty. This means that if I could forecast GDP perfectly, inflation-linked bonds and GDP-linked bonds would have the same interest rate, okay? But because there is GDP uncertainty, we find that GDP-linked bonds interest rates, which are the black line, the black solid line here, are going to be marginally higher than inflation-linked interest rates, which are the gray solid line here. And the wedge between the two is what is known as the GDP-linked bond risk premium, which is of about 40 basis points across the maturity. We also have the nominal interest rate, but obviously the nominal interest rate is going to be higher than the real interest rate because it compensates for inflation.
Can you tell us why so the curve, the slope of the yield curve is not totally captured here by the model? So you have a more complex at the, what's your interpretation of this?
So we do not have an interpretation for this. So what I can say is that our model can replicate an upward sloping real yield curve, which is not granted in such models. In fact, this is why we needed habits to be able to do that. And I can explain further how it works in the model. But importantly, the fact that it's getting narrower here is most likely something that should not be interpreted as an economic result, but more likely a statistical outcome. So I think it has to do with the precision and based on the fact that we have less data points as the maturity is higher. So what I would insist on is on the fact that the wedge is relatively stable across the maturity on average. This is a result that we can stress with confidence, but then we can also stress that we can replicate the upward sloping real curve feature, which is also visible in the data. So this is great news. But then whether the slope gets less steep with the maturity, I think that this has to do with the precision of the model at higher maturities. So as I said, so up until here, you see the outcome of the model. So we have our macrofinance variables. We got our trajectories for our yields. And now I will go back to the original slide. So this is the slide I had at the beginning of the presentation, and I want to remind you of the different assumptions we were trying to relax. So remember, in past papers, what they were looking at was the debt accumulation process, assuming only one period bonds. And assuming constant interest rates. So what we've done is we've relaxed this very first assumption, and we've allowed for interest rates to be time varying and to vary along the maturity, and therefore we've introduced also longer term debt, and essentially we allow the government to issue bonds at any maturity for any type of bond. So in order to be able to study what the debt accumulation process will look like, we need to generalize the debt accumulation process and allow for the issuance of nominal bonds, real bonds, and GDP-linked bonds. And we want to allow for the issuance of these type of bonds for any maturity, little h, that goes from one period to h periods. And as you've noticed in our model, we will go up to 50 years, which is really considered very long term. As far as I know, the longest maturity of debt that is issued by governments goes up to 55. Obviously, you can go to any level you want, but the precision, as Helene has spotted, wanes down as we have fewer data points along those maturities. So what we're going to do is we derive this debt accumulation process, which in fact is it's outside of the model. So we are extending the debt accumulation process for the issuance of any type of bond at any maturity, and by incorporating the fact that interest rates of these issuances will vary across time. And so the nice thing about this generalization is that it can be used also in the context of the papers that Helene cited that look at optimal maturity structures. They might find this debt accumulation process useful for their analysis. So what I want to stress is that this debt accumulation process is highlighting a few things. It's saying that if only nominal bonds have been issued in the past, inflation or real GDP surprises will have a negative effect on debt. Okay, this we know, that if you issue only nominal bonds, inflation will allow you to, in a way, deflate the level of your debt. Okay, so that's one thing you can notice from this debt accumulation process, which is a known statement. Similarly, if only inflation-linked bonds are issued, a GDP growth surprise again will essentially decrease the debt accumulation process here. And finally, what is interesting is that if only GDP-linked bonds have been issued, debt will be immune to day T inflation or GDP surprises. As you notice, YT minus K T minus 1 does not show up, or YT minus K T do not show up on this segment of the equation. Remember, this is for nominal bonds, this is for real bonds, and this is for GDP-linked bonds. So indeed, there is some immunity against some transitory fluctuations that GDP-linked bonds do offer. However, debt is going to continue being affected by future GDP-linked bond interest rates and by future values of nominal and real interest rates. And this is something that you could only see if you studied it under higher maturity issuances. And so this is the part of the paper that we are actively contributing to by studying the full term structure of such assets. So what we see is that more generally, debt will depend on the debt strategy, so the choice of the issuance, on the budget surplus, and on the dynamics of interest rates. Okay, so A and B are essentially determined by the government, and C are out of the control of the government. So a natural simulation exercise we would like to do is we will posit a simple process for the budget surplus. We will consider different issuance strategies, and we will define the strategies along different dimensions, along the type of the bond being issued, whether it's nominal, inflation-linked, or GDP-linked, and along the dimension of the maturity. Okay, and this is what I want to stress again. It is not a normative paper. We are not maximizing anything, so it is not following the literature on optimal debt. And more specifically, we are going to be interested in the smoothing performance and on the implications of using different debt instruments. Okay, so it's more of a positive approach based on specific based on specific assumptions on the issuance strategies that a government could have. So let me show you some first results on this first simulation exercise, where I've assumed an initial debt to GDP ratio of 100%, and I've set the budget surplus to -1%. So on this column here, we will be studying this strategy on a short horizon of 2 years. On the second column, we will be studying it on a long horizon of 20 years. And the first line will be based on issuances of only short-term debt, while the second line will allow for issuances of long-term debt up to 10 years. Okay? So the first takeaway message is that indeed, GDP-linked bonds, because they have this positive risk premium that is embedded in them, they will have a higher debt to GDP ratio on average. If you notice the black line, which is the black curve, which is for GDP-linked bonds, is shifted to the right relative to the curve of inflation-linked bonds and nominal bonds, of conventional bonds, which is in gray. But what we also notice is that this distribution is essentially taller, meaning that there is less dispersion, less volatility around the debt to GDP ratio. So this means that it is more predictable. Now, what is interesting is that this predictability wanes away with the horizon of the strategy. And why is that? Well, simply because as the horizon increases, the future GDP-linked bond interest rates and nominal and real rates for the remaining conventional bonds will start playing a role and will start inflating the level of the debt to GDP. So the first finding is that although GDP-linked bond issuances do make the debt to GDP ratio higher on average, but more predictable, the predictability wanes away with the horizon of the investment strategy. If I were to look at the debt service distribution now as a fraction of GDP, well, in this case, the debt service would be higher, meaning that you would pay more on average for your debt, and this is coming from the positive risk premium. However, this debt service will be more volatile. Why? Because it's acting as an automatic stabilizer. It's allowing the government to service its debt less in bad times and more in good times. So it's automatically adding volatility to the debt service dynamics. Now, what I've shown you is actually a strategy that is a bit debatable, right? I've put strong assumptions. I've set the debt to GDP ratio to 100%, the budget surplus at -1%, and it's ad hoc. I could have put other levels and found other debt to GDP ratio dynamics and plotted them. Let me try and go to something that is to a simulation exercise that is a little bit less ad hoc. So let me consider now the dual problem. So the opposite side of the coin. I want to see what the budget surplus would be if the government wanted to keep debt constant. And this strategy is nice because it complies with the fact that governments don't want explosive debt in general, although sometimes they cannot help themselves from it. But a priori, fiscal rules would suggest that a relatively stable debt is preferred. So it's in line with what a government would want to do. And also, it allows my process to essentially be stationary. Okay. So let us try and understand what I will call the debt stabilizing budget surplus. Okay. What are the net revenues the government needs to have to stabilize debt? So I will go back to my little example here just to give you a bit the intuition. The budget surplus is the net revenue of a government. So in a simplistic example where you can only have short-term debt, well then the budget surplus, so debt today, for it to be constant vis-a-vis to debt of the previous period, it will have to have a budget surplus which is essentially higher so that it can compensate for the aggregation of the interest paid on debt. And so we want to find what this budget surplus is. And the higher the budget surplus, the tougher it is for the government, right? Because they will have to raise more money. While the lower the budget surplus, the easier it is for the government to stabilize debt. Okay? So this is the object we're going to be interested in, what we will call now the debt stabilizing budget surplus. So let's see, under GDP-linked bonds, if I issue GDP-linked bonds, on average, the debt stabilizing budget surplus will be higher, meaning it will be harder for the government to achieve it relative to conventional bonds. However, the standard deviation of the budget surplus will be lower on average than under conventional bonds, where the standard deviation would be up here. And what does that mean? It means that the government would need higher net revenues, yes, but they will know in advance that they need to deliver these high net revenues. So they will be able to prepare themselves well in advance and to know what they need to generate as a budget surplus in order to stabilize that. Similarly, with the standard deviation of the changes in the budget surplus, this standard deviation is also smaller, which suggests that it's smoother. The debt stabilizing budget surplus is not only going to be less volatile, it will be smoother from one period to another. So everything that I show you here is suggesting that debt to GDP-linked bonds would be more expensive, but they would reduce volatility and improve predictability for the government. However, if we are going to look at tail risk and the tail of the distribution by looking at higher percentiles, such as 90th percentiles or 95th percentiles of debt stabilizing budget surpluses, what we find is that we paint a less favorable picture for GDP-linked bonds because the debt stabilizing budget surplus is disproportionately higher under GDP-linked bonds than under other issuances. So it means that it would be very demanding for the government to be able to produce these revenues. So in the last few minutes, I just want to briefly mention, because I assume that I'm out of time, I just want to mention that there are a few things that are not in our paper, meaning that, first of all, we were studying this in the context of a closed economy, and that one could think that you could allow for risk sharing by introducing a second economy to the model. But what we want to show is that the diversification across advanced Western economies, at least, seems to be unlikely to markedly reduce this GDP risk premium. And we've done a very brief exercise where we look at the correlation between 2-year ahead GDP surprises for different countries. And we do that in different sub-periods. So we have for the full sample we've been studying, but also a sample that is a bit more recent. So we take half of the most recent half of our sample. And as we can see, in the context of advanced Western economies, the correlations in 2-year ahead GDP surprises are extremely high and would make diversification benefits weak in that context specifically. So to conclude, what we've done in this paper is we've provided an extension of the Werchter 2006 paper, which is a habit-based model. We've extended it to allow for the pricing of GDP-linked bonds. And on a more technical side, we've also allowed for the analytical pricing within the context of this model. This allowed us to extract the full term structure of GDP-linked bond premiums, which allowed us to study the debt stabilizing properties of GDP-linked bonds through the generalization of our debt accumulation process. And what we found is that GDP-linked bonds would embed positive countercyclical risk premia, that issuances of such state contingent assets would make it more easy for the government to forecast debt to GDP ratios in short to medium term horizons, but it paints a less favorable picture in the long run if you are to use this strategy for over 20 years. And finally, the debt stabilizing budget surplus would be more predictable but higher on average, so more expensive for the government. So overall, our findings call into question the view that GDP-linked bonds could tame debt. Thank you very much.